Have you been pre-approved?
Or pre-qualified?
The difference coming right up. Everybody, my name is Barry Horvath, and this is Moving Forward TV with your local market update.
And I am Delynn Gaston. Thank you so much for joining us. So one of the questions we get from our realtor partners frequently is the difference between a pre-qualification and a pre-approval. You hear those two words floating around a lot.
There's a difference?
And they'll call us and say, well, I need a pre-approval or I need a pre-qualification. Everybody's a little bit different. So we figured we'd go over the major differences in those two things. There are differences.
There are significant differences. You like that word?
Significant differences.
This is our morning show too, folks. So it's significant. If any of you know me, that's a really big word for me in the morning. So
he is not a morning person.
I am not.
If I say to him,
But
hey, we have to be somewhere at 8:30, he'll say, Eastern time?
Yeah. So here we are trying to come up with the biggest word we can at this hour. So. Significant will be it.
That's good.
I know.
Okay.
That's good.
So some of the significant details about each of those. A lot of you already know, and I think I'm going to prep this show by saying, by all means, feel free to send this to your home buyers because we're kind of going to go over with them what they need to know about and the differences between the pre-qualification and the pre-approval so that they are ready to go with you to look at houses.
Well, you know what? That's one of the big calls that we get all the time. Hey, Barry. Hey, Delynn. I have a pre-qualified buyer for you. I need you to pre-qualify. Right. I need a pre-approval for them. You know, they're like, oh, look, Delynn, you're like stealing the show.
I know.
Hello. This is what you should do. I will say something, you move your lips.
Hey,
we're back.
Sorry, technical difficulties.
I wanted to see if I could do that ventriloquism. I've always wanted to try that. Anyway, we can make fun of anything in life.
I know.
No, it's all good.
We just roll with it.
So basically, you want to get somebody pre-approved, and a lot of people have no clue where to even begin, where to start. So pre-qualification is really simply, in layman's terms, an interview to me, because
perfect word.
Yeah.
Hey, another good word.
Yeah, interview. Interview, I-N-T. I'm just kidding. We don't need this. It's not the spelling show. So we're going to interview the potential buyer, whether it be you or someone you refer to us, on the, their qualification. What do they qualify for? And the difference a lot of times, and I hear you say this to people all the time, what you qualify for and what you want your payment to be.
Two different things.
Yeah, maybe two different things, because sometimes people want to max out their buying power and they're okay with that. And some people are like, payment. I can't be over $1,200 a month. That's my maximum amount. So
they might qualify for $2,000 a month from a qualifying standpoint, but from their comfort zone, they don't want to be more than $1,200.
Exactly. So it's important to know the difference between pre-qualification and pre-approval.
Absolutely.
So pre-qualification, we're doing the interview. We're asking them all the pertinent questions,
The 4 parts.
Yes. So
4 keys to getting your keys.
That's it. So basically, the first thing is always usually about income. Mm-hmm. And we want to know, where is their income derived from? Somebody who's self-employed that says, I make $10,000 a month, and then when you look at their tax returns, it's harder to pre-qualify a self-employed without looking specifically at their tax returns.
And for our realtors out there, we will say that when somebody is self-employed, it's not something that we can give you a pre-approval on immediately, because we absolutely want to see the tax returns, because I'll be honest with you, people will tell us that they make like you said, $10,000 a month, because they do make $10,000 a month. But what they don't realize is what we're looking at is the bottom line. So if they make $10,000 a month and they write off 9,000 of it,
Yeah, they make 1,000.
and expenses, then I can only
Which
count
qualifies
1,000.
them for $400 a month, which is a $60,000 condo.
There you go. Look at that.
Out there, and yeah.
Not a condo, because they have HOA fees.
Yeah, you're right. HOA fees are too high. So they can get $60,000 out there in Bushnell, Florida, and be out in the country and enjoy it. And if any of our viewers are out in Bushnell, that's not made to offend you. I might remind you of that. Sometimes our show can be offensive, can it?
I guess. Just we don't mean to be.
No. We just like to give examples.
But yeah, so but I'm a self-employed person. I'm not even going to. I will call you back and tell you, hey, I spoke to the person, Mr. So-and-so or whatever, but they're self-employed and I really can't give you any answers until I see their tax returns, because I don't want to give anyone false hope.
Exactly.
That's-
And on a W-2, which means taxes and insurance, it's much more cleaner cut. But you know what? Sometimes we have a combination of both of those. Like, oh yeah, I work at the same job for 30 years. I'm W-2. They take all their taxes. You know, FICA's taken out, Social Security's taken out, or your, your withholdings,
Right.
whatever. We count on gross. But then they have this Mary Kay business that they do on the side, and suddenly they have this giant write-off. Well, guess what? That's going to come up. So that's why part of the interview pre-qualification process are questions like that. Do you have a side business?
And we're very pokey. We poke.
That's it. I know.
We ask lots of questions because we don't want this, blindsiding us.
Right, yeah. And why do we ask for tax returns? Because those blindsided things come up. Let's face it.
We've been down that blindsided road more than once.
I know nobody wants to hear this, but buyers are liars. That's just, and they don't mean to be.
And I, on the other hand, I was going to say, I don't think they mean to be. They're just,
omitting information that we need to know.
And they don't know we need to know it.
Right. They don't think it's important. All they know is they work on their job and they've been there 30 years.
And they have this little side thing that, doesn't make a difference on.
No.
Well,
and they
sometimes
write
it does make a difference.
So income, we're looking at all the income that may affect.
Oh, sorry.
Oh, don't worry about us.
Alarm.
We're on the show.
Civic Fair's coming up soon.
We'll get back to you later.
The other thing with income that I did want to say is job history, 2 years. So this is the other thing that we hear a lot of, is that they haven't been on their job 2 years. That's okay. You don't have to be on this particular job for 2 years. You just have to be in the same field for at least 2 years.
Or be a student or a study of the field that you are working in.
Right. Somebody could be an electrician, and he could be an electrician on a new job for like 2 months. I have a young man right now, actually.
Hi, Bill.
And he's only been on his job for like 6 months or something like that.
His
but
name's not really
he
Bill,
went to school to become an electrician.
Right. So it does.
That counts.
It does. Yeah. And a lot of people don't realize that.
Right.
So income is the big part of the pre-qualification. Okay. What's number two?
Number two is debt. This is the who do we owe?
Yeah.
Who do you owe?
Who do you owe?
So I'm getting sung to too. All right. So we do not count things like your insurance that you pay on your car, or your life insurance, or things like that. We're looking for loans.
Your cell phone bill, we don't care.
We don't care.
That went in. Cell phone bill.
Cell phone bill, we don't care. So, and the other thing that they don't care about, unless it's a VA loan, which I'm kind of surprised at, is daycare.
Yeah.
Daycare is a huge expense for people.
Right.
And so far, and this has been 40 years that I've been doing this in the industry, they don't ask about daycare. And personally, when my kids were in daycare when they were young, I was like, okay, that's like a real expense to me.
Yeah.
So make sure when we're talking about maxing out, what you qualify for, you got to be really comfortable with what you're.
VA.
It does play into it in VA, but
VA
FHA
loan.
or conventional loans do not ask about that. But the things we do ask about are things like your car payments, your loans, student loans, personal loans, credit union loans, motorcycle loans, RV loans, boat loans, toy loans.
Credit cards.
And then credit cards.
And then the big one that often gets omitted is this thing that's so common, sadly, welcome to the United States of America, alimony and child support actually do count as a debt. Sadly. But
we ask that question of the borrowers right up front. If you are a borrower, if your realtor has sent this to you, please make sure you disclose that information to your loan officer. Your loan officer sometimes will forget to ask about it. We make sure we ask about it all the time. Again, blindsided. We don't want to be blindsided by things like that. So make sure that you disclose it even if they don't ask. Don't try and hide it. We've had people try and hide it from us. Guess what? It comes up.
and if you are getting child support or alimony, it may be counted as income as long as you can prove you're getting it. You may have to show a divorce decree to prove
Either
that.
way, we have to show a divorce decree
Yep.
and or child support agreement.
Yeah, we have one right now that, he didn't tell me about this alimony. Well, it's not written anywhere, but it's on his tax return.
Because it's tax deductible.
He's like,
Alimony is.
I got a big write-off for that, so I put it on there. I didn't think it mattered. Well, it does.
It does.
Yeah, it makes a big difference.
And I know, and some people don't realize that. And if you are receiving it, just so that you know, you don't have to use it to qualify. It is absolutely not mandatory to use it. If we need it, then there's going to be some extra documentation and things like that we're going to have to prove. We have to prove that you're receiving it. So if your ex-spouse or whoever is sending it to you via check, I need a year's worth of checks showing that. Sadly, there's a lot that goes to it. I usually say to people, if we don't need it to qualify, let's not even use it.
And the other thing that people often overlook is sometimes you have a child that you have nurtured, brought into the world, you've helped them through life, and they're like, Mommy, Daddy, will you sign here for me so I can get this
co-sign on my car loan.
I need this new car because it's only $800 a month and I can afford it. I'll make the payment every month, I promise. Does that sound familiar?
It's only $800 a month.
It's only $800 a month, and it's a beautiful car, and it's at 0.9% interest right now due to COVID. They're offering great financing deals. It's year end, and you're like, okay, I'll sign. And then you sign, guess what?
Yeah, it's going to count into your ratios, even if you say to me, but he's been making the payments. My son has been making the payments, or my daughter has been making the payments.
And how they make the payments? Oh, they
give me the money and I pay it.
Yeah. So
I gotta
and
take
that can work if it's the exact amount or a consistent amount. And they're like, well, they pay me for their cell phone too. And they lump it in there, then it gets
or their
a little
insurance
sticky.
too.
So we still have to count that as a debt more times than not. So keep that in mind. All right. So what's next? So we talked about all the different debts.
So that is income and debts.
Income is first.
Right.
Debt second. What's third, Dylan?
Credit.
Credit.
Right. From debt into credit.
You know what's so funny? Credit's 3 on our list. So many people think that it's number 1. They're like, I can get a house because I have beautiful credit. My credit's 800. I'm like, yeah, so.
And that is a good question to ask kind of up front.
Yeah, it's not really the number 1 thing.
But it's not it takes all 4 of these pieces to this puzzle. Like we said, you need all 4 of these things
It's
in
like
place.
getting a stool with only like 2 legs.
Yeah.
You're like this.
You got to balance the whole time. May or may not fall.
Yeah.
So in the credit world, going right from debts to credit, so on that son or daughter that you have co-signed their loan, have they been making their payment on time if they're making it?
Yes.
Because that is going to tremendously impact your credit score and your credit score, not only if they've been making their payments, but also how much credit do you have versus, available credit versus used credit. So those factors all into your credit score. So you might find when you co-sign or something that your credit score goes down a little bit.
And you know what don't you wonder this, when someone says, what credit score do I need to qualify?
Yeah.
And if someone asks you that, that's like buying a Corvette and saying, what kind of gas mileage do you get? You just don't, if you can buy a house, and I know people are concerned and want a specific score. If your credit's not good or decent, you're not going to get a house.
Right.
Or you shouldn't be. And I always like to see people get their score up. I know, like, you heard me yesterday tell someone you need 640. Well, the guidelines have changed. We went up to 660 during COVID.
I know.
We were at 580 at one point.
Right.
Minimum credit score and an FHA. I like to say 640 because when you're at 620, while you may qualify, it's not pretty because the hits to the rate.
It's going to cost you more.
It's going to cost you
the
more.
lower your
your
score, it's going
payment's
to
going
cost
to be
you more.
higher. And then there's also other criteria like the reserve requirements. They're going to want to see you have more
Exactly.
assets aside. So
Probably have to pay points
yeah,
to
it's
get that
not
high rate.
that 620 is not pretty. While you may qualify it, and it'll be harder. The underwriting guidelines are definitely more stringent.
So if you do have any credit issues, or your clients, if you're a realtor watching this, if your clients have credit issues or whatever, encourage them to get with a credit person to try and get that score up. Obviously, the higher the score, the better the program that they can qualify into, and the better their interest rates and their terms and conditions are going to be. That's very important.
You know what you and I have been discussing lately? If you're under 700 right now,
Yeah.
you're probably not a conventional buyer. You're probably an FHA.
You know, and
or
it used to be
VA.
on the conventional, it would go down to 620 and everything was fine and dandy, like we said.
Right.
But things have changed. Things have definitely gotten stricter, and I'm not sure if it's just since COVID, and or
seems
maybe
like
it does seem like it's since COVID. It's definitely gotten stricter. Whether it's going to ease up again after, once we're kind of through all of this, I don't know, because I think that it's kind of pushing people to
Right.
get better.
Right.
To make better decisions and choices and try and get their credit fixed. So,
Well, the big part on conventional is the MI factor,
Right.
which is the insurance that you have to pay for.
PMI, you probably heard it.
Yes, to borrow, to insure. This is an insurance policy that guarantees the lender you're going to pay. With FHA and VA, it's funding up front, one-time fee, and you never have it again. And on FHA, it's a monthly fixed amount of 0.85 on a 97. It's 0.80.
Right, and less than 95.
Less than 95. So people that are putting more down will get a lower MI, but it's still there. So again, and that's part of the pre-qualification because that affects their debt ratio.
So if somebody does have under a 700 credit score, it's definitely, they're not, people see out there right now, oh, interest rates are like 2%. That's if you have an 800 credit score and you're putting like
it's so
50%
funny.
down.
It was just last year we were making funny people saying, what's your interest rate? 2? Like that was realistic.
I know. And
Now it's realistic.
And now they're in the 2s. It's
Yeah,
crazy.
I know.
They're in the 2s if you're putting 50% down and you have an 800 credit score.
Yeah, there's a
So,
lot of factors playing.
Lots of factors.
So
that go into
credit is number 3 on our stool, and make sure and having on your credit can affect your pre-approval. Like a collection can affect you. You might have to pay it. So we need to look at that. Repossession can affect
definitely
you.
encourage, the credit karmas and things like that. It gives you like an idea, of snapshot of where you're at. It's not going to be what we pull when we pull for a mortgage credit report, but it's going to give you an idea. We also recommend annualcreditreport.com. If you're not sure what's on there, and if you do a Credit Karma and you see that your score is like a 597 or a 618 or something like that, by all means, I encourage you to get your credit report. Annualcreditreport.com.
It's
You
free.
can get a free credit report once a year from all 3 of the repositories: Equifax, TransUnion, and Experian. Get it. Take a look at it. See what might be pulling it down. I'm happy to take a look at it for you as well, and together we can kind of like analyze it and figure out what's making your score come in
You
low.
know what? They don't give you a score on annualcreditreport.com
No.
unless you
So
pay.
I was going to say, annualcreditreport.com is free. However, if you want your score with it, you have to pay a fee.
Right. And you can go to Credit Karma and get your TransUnion score, and you get one other now too.
Yeah, you get 2
now.
scores for free,
Right.
but you don't get a report.
And those won't necessarily match the score that we get. In fact, I promise you, they won't.
They won't. And that's a whole nother show
Yeah,
when we
that's
talk
it,
about
yeah.
credit scoring and
Like,
analyzing.
No, I just pulled it. It was a 680.
Yeah.
How come it's only a 640 with you? Because we're mean.
I tell people, it's a consumer score. We're lending you money, lots of money.
Yeah.
Chances are
It's
we're going to be a
totally-
little stricter on algorithms, and that's the industry. That is not us individually,
No,
Em and I.
we're just mean.
Industry.
I think we're mean. All right, so
All right, the fourth part.
All right, so
the
we
fourth
got
part.
income,
Fourth
debt.
key to getting your keys.
income, number 1.
Yep.
Debt, number 2. Credit, number 3. What's number 4, Dylan?
Assets.
You got to have assets?
Assets, checking, saving, and we don't mean, I have a car that's free and clear. No loan on it.
It's
No.
not liquid.
We mean checking, savings, money markets, IRAs, things like that. How much money do we
Mutual
have?
funds, stocks. liquid.
Verifiable money.
Right.
that we are putting towards this transaction or have the ability to put towards
during the
transaction.
pre-qualification, it's super important we know what assets they have and what credit score and what their income is, because that can determine which loan program they're going to go into.
And ultimately, that's what we're trying to get them to a pre-approval.
As we poke
And ask all of our questions under the pre-qualification part, which is just hearsay, so to speak. This is what you're telling us about. We're determining in our head which program they're going to fit best into.
So the assets part, having 20% down with
Right.
a 620 credit score doesn't mean you're a conventional buyer.
Doesn't automatically mean it. And I know a lot of people want conventional buyers out there because they're afraid of the government, FHA and VA and USDA
Yeah, because
programs.
the appraisals are different, right?
There's so...
And they charge extra fees to the seller, right?
Such a myth, such a myth, such a myth, I got to tell you.
There's no sarcasm here. Sorry.
Conventional is not always best for someone. Even if somebody has a 679 credit score or whatever, a 680 credit score, you'd think, oh, that's a pretty good credit score. But I compare the mortgage insurance and such. Where's their payment going to be better for them? And maybe they don't have a whole heck of a lot of money, so they need some help from the seller with closing costs and things like that. FHA tends to be more flexible than conventional is with that. So there's a lot of ifs, and as we're asking and poking our questions, we're going to do those things.
All right, so the assets must be verifiable.
Yes, that's the other thing. Got to be in a bank somewhere.
Yeah, it cannot be in a mattress.
Cannot be, buried in a coffee can in the backyard.
That's so funny. I always ask people that. Where they go, well, I have $10,000. Well, where is it? I don't have it yet. Well, where are you getting it?
Yeah.
Well, it's been in the backyard for a while. I think I can find it. I love that one.
Or they just say, don't worry about it, I can get it. No, I have to worry about it. That's part of my job.
And it can be a gift, and that can count as an asset, but we do have to verify it. Again, all part of that pre-qualification.
Right. We need to know all of these things so we can place them properly into the proper program and issue a pre-approval letter.
Okay.
Under a pre-approval letter.
There we go.
Here we go.
I was wondering when we're going to talk about a pre-approval.
All of that is what's called pre-qualification, and all of that we do over the phone most of the time. Sometimes
Yes.
people will come in, but most of the time we do it over the phone with them so that we can get a handle on it. And then I basically say to them, okay, everything you just told me, now we got to prove. So I need the documentation to back it up. So I need your pay stubs, I need your tax returns, I need your W-2s, I need your bank statements to make sure that money is truly in the bank and not buried in a coffee can in the backyard. So we need to verify all of these
those tax
things.
returns to make sure they're not writing off everything.
Exactly.
Because they forgot about that business.
That
they had.
side business.
And they had a side business 2 years ago. Well, I don't do it anymore. But SunBiz says you do.
Right.
We'd have to maybe close it. So that's part of the pre-approval. And we upload everything in the system, and we run electronic findings through Fannie Mae, Freddie Mac, FHA.
It's called an AUS, Automated Underwriting System. And it actually comes back and gives us an approval or a not approval.
Right. And it'll tell us what we need in order to close the loan.
Right.
And the documentation in that approval may be less than we initially asked for. Like it might say, well, we only need, 1 year's of tax return.
Right. Which
instead
is great.
of 2 years. So it makes it easier. And
Right.
it might verify, we need to see this many assets, even though you said you had $100,000 over at Vanguard
Right.
investment, but we don't need it. But, it's a scoring system that's automated.
And we read through those, what we call findings, very closely because, like you said, if we've had this happen, we have actually saved deals because instead of averaging on a self-employed person 2 years tax returns, we were able to run the findings and kind of, make the thing work so that it only was asking us for 1 year tax return
Yes.
instead of 2 years tax returns, which the person wrote everything off in 2018, but in 2019 they didn't. So they actually showed more income. Just under that one tax return, we're able to save the deal.
You know what? A true pre-approval requires a lot of investigation,
Right.
interviewing, gathering of documents.
And that's why we're so
I know.
thorough on our
And I have to
interview
tell
process.
you, and I'm not picking on the big boxes,
Right.
but I will.
Okay.
Because
Good, 'cause I
how
would've.
many pre-approvals have you seen where they call their big box bank, whatever, credit union. And there's a lot of wonderful people that work at them, and there's a lot of people that do a great job. But a lot of them, unfortunately, they don't require the licensing that we do.
Right.
They don't have the training we do.
Right.
They are they're what I call an order taker.
An order taker.
So they put in your social security number and they get your
Yeah,
pay
and that's
stub.
like the first thing they do too, which is run credit, which drives me crazy.
Yeah,
Why
they're
are
like,
you even
"Let's
pulling
go."
credit if they don't qualify?
No, I know. Then they do. They run your credit and they're like, "Oh yeah, you're good."
Yeah.
And then they're like, "Yeah, I've been pre-approved at my bank," and they said I qualified, but they didn't dig into it.
Right.
And they were self-employed and they didn't know
Right.
that they
And they
was
just,
right off.
I make $10,000 a month, and again,
Yep,
the borrower
you're good.
didn't know any better. Yep, you're good.
You're good.
You
And
know,
then the
and-
realtors come to us mad and say, "I'm waiting to hear back from someone at this institution." But it happens a lot.
Who advertises a lot on television.
Yeah, yeah. So you should use them because they're the best.
They have something like a quick kind of thing.
Yeah, because it's really fast. It's so fast. It's like a rocket. Okay.
Not always the best choice. Fast isn't always the best.
Anyway, let's move forward and talk about upcoming events.
What do we have going
Well,
on?
actually, you know what? We had an awesome
Lunch and Learn.
Lunch and Learn, and we do have
With
another one.
Nikki Alvarez-Souls, our clerk of court. It was wonderful. If you guys didn't catch it, I'm sorry. We will try and have her again. And somebody asked me, I wish we could film them. Maybe we should talk to our producer about maybe
Yeah.
filming them.
Actually, I talked to a realtor last night.
Who said that?
That was
I
the
wish.
best Zoom meeting they have ever been on. And I'm like, I've seen it
Ow.
twice kind of now.
I know, me too.
She did tailor it more to the realtors with
This
us.
time.
But she did a great job. But here's
She's awesome.
She is great. And
Yeah.
thank you, Nikki, if you watch our show, because I'm sure you sat through all 26 minutes of us right now rambling. And you want to be pre-qualified because we know you're looking for a house. But anyway, that's another story. Thanks for sharing your time and
Inside
being a
joke,
part of it.
because
Yeah, it's all good.
Nikki needs to move.
Yeah. Yes, but our next one is going to be great. It'll be on September 9th, I believe is the date.
Oh, no, look, he's reaching for his phone. I think so. It's always the second Tuesday of every month. So all of you, any licensed realtor
It's September 8th. It's the other.
is allowed to join us.
It's Tuesday at 11:30. We will have the president of the West Pasco board talking about social media, Mr. Mike Gallo. Thank you, Mike. He's been on before and did compliance. Now he's going to talk about more strictly social media marketing, which all of
what
us
you guys
need
can
right
and can't
now.
do, which is
Yeah.
awesome. Especially when we can't do face-to-face things anymore.
Yeah, social
Everything's
media is
electronic.
big. You need to be out there. People need to see you. You need to be in front of them. Maybe some of you found us on social media, and that's why you're watching our show. So thanks for sharing our show. Thanks for liking us.
We appreciate everybody watching.
Yes,
we are
we do.
today and every day.
Moving forward.
We'll see
Hey,
y'all next
great
week.
information this week. We'll see y'all next week. Thanks.
Bye-bye.